Good morning. UBS says gold's muted response to rising geopolitical tensions is only temporary, with tariffs, Fed cuts, and structural supply constraints setting the stage for a near-term move to 6,200. That's a near-term move. And this statement was made before Trump pushed back with the raised tariffs. Second, Washington is now bundling infrastructure with innovation to keep emerging markets on U.S. digital payment rails as China's build and finance model reshapes the global economic playing field. In a sense, the Eurodollar milkshake is dead. A digital milkshake is being reborn or born. First, the markets. 10-year yields are unchanged. The dollar is up 21. The S&P 500 is 68.35, down 9 handles. The NASDAQ is bouncing. 24,750 up 13 handles. The VIX 21.47 up 45. Gold is down $70 on the low of the evening. Silver is 87.67 down 45 cents, but a much wilder ride. Was up, was down a lot more. There seems to be a decoupling between these two markets right now, and the Shanghai reopen is showing that volatility. WTI is up 31 cents, comfortably above 66 now, 66.70. Natural gas is down 5 cents. Platinum is up 19. Palladium is up 10. Gold, silver is down 47. And grains are mixed, with soy down 4 cents, corn unchanged bid, and wheat unchanged bid. Bitcoin is down 1,500, breaking out of that little wedge that I described. So there could be some momentum lower now, although I'm not sure. First up, UBS sees gold as 6,200 near term on geopolitical risks and tariff troubles. UBS maintains a near-term gold target of 6,200 as tariff uncertainty, rising geopolitical tensions, and anticipated Fed rate cuts support hedging demand, with global demand exceeding 5,000 tons in 2025 and mine supply expected to stagnate through 2028. Easing real rates and continued central bank buying reinforce gold's structural upside despite recent muted price reactions. Now, that was their take on Friday before President Trump said he was going to add 15% tariffs. So for them to be over Goldman Sachs's target and saying this before Trump reacted to the Supreme Court ruling tells you that they're probably even more friendly to it. But we shall see. Next story. If you're a fan of Tom Luongo's work, especially with focus on how the Eurodollar is in jeopardy because the U.S. is repatriating its payment rails and it's charging for access to them and other things that are going on, or you're a student of the Brett Johnson's milkshake, then this might be of interest to you, because this seems to be finally the real physical path that we're going to be going on to replace the dollar milkshake. So let me just start with a couple points before I read the summary. Dollar's dominance as a global reserve currency is under structural pressure. There's no argument there, right? China's infrastructure-led economic model presents a competing pathway for alignment. As globalization fragments, globalization is dead, right? The U.S. must offer more than capital markets access. It used to be, if you join the dollar, you get all this other stuff. Now we got to give you all this other stuff for you to hold on to the dollar. Building supply chain security with innovation and financing forms of a broader effort to preserve dollar status are part of the plan now. So you can look at it like a programming stack. A fuller U.S. technology and infrastructure stack should help offset Chinese inroads and sustain reserve currency influence at the regional level. Essentially, the dollar has lost in competition with gold to be the store of value. But as a medium of exchange, it's trying to hold on to that. So to put it in context, the recent U.S. summit with India signals a deeper shift in how Washington is competing for influence in a fragmenting global system. For decades, the Eurodollar framework allowed the U.S. to extend monetary gravity without deploying physical infrastructure, except for the military when needed. Today, that model faces pressure as China finances ports, power grids, telecoms, and now AI-ready data centers across emerging markets. In response, the U.S. is pairing capital with compute, minerals, and sovereign data infrastructure to shape the operational rails on which 21st century trade, payments, and innovation will run. This presents an effort to preserve dollar alignment through deployment and partnership as globalization gives way to a more regionally negotiated economic order. Okay. Dense word salad aside. We used to go around to the world and say, use the dollars to get protection. Use the dollars to get financing. Now we're saying, we're going to give you financing. We're going to give you infrastructure. We're going to give you protection. Please use the dollars. And that's what the deal was with India. China's Belt and Road Initiative has made significant inroads into undermining the dollar's global use as a currency. It's already fucking lost the war as a store of value. It's over. Now, there's going to be pushback and there's going to be reminders of how dangerous it is to not have dollars. No argument there. But the world is moving towards regional stores of value. The yuan, the dollar, in terms of currencies. But in terms of the big mama, it's gold. Gold is the store of value that is preferred, period, over everything now. And silver's probably going to be coming up soon if they can get away with it. Now, that means if money is three things, a store of value, a medium of exchange, and a unit of account, there's only really, the only thing left is the dollar is a medium of exchange. And they want to make sure that the payment rails that everyone uses are dollar payment rails. And that's how you preserve the dollar milkshake, so to speak. You swap the Eurodollar out for the full stack. So it's the full stack milkshake, for lack of a better word. We think this is extremely significant because it's the first, it's not going to make any headlines yet, right? But it's the first cohesive attempt to win a nation back, meaning India, from China with what I would call a full stack dollar play. Use the dollar. Here's what we're going to do. We're going to give you money. We're going to give you access to our technology. We're going to open our books to you. We're going to give you physical defense if there's a war in your area, and there will be wars in your area. And we're going to lend you money. That's everything that China's doing. We're doing everything that China's doing. We're focusing on the payment rail, right? And in focusing on the payment rail, if you use dollars, we'll protect your supply chains. Give us your supply chains. We'll give you dollar access, most favored nation status, and what have you. Look, this is the future of trade. Now, the reason I think it's significant, aside from the fact that it's interesting, is the Eurodollar is dead. I mean, it was killed like with this meeting. And so they're not going to go out and disassemble. There's not going to be an announcement. The Eurodollar is dead. They're just going to let it die on the vine. People that are going to use it are going to use it. And if it comes in handy, it'll come in handy. They're not going to delist it. It's just going to be there. And people are going to use it. And it's going to be very powerful for an extended period of time. But it will shrink incrementally in importance in the big picture as a function of the US dollar being a global reserve currency. That's not to say the US dollar will remain the global reserve currency. That is to say that we are now reacting to China. I mean, let that sink in. We are reacting to China now. China's not reacting to us. We are adjusting our game plan and offering more at the table with other countries just so they keep using dollars. That's how important the dollar is to us. Anyway, we sent that out this morning as the Eurodollar milkshake dies. This is the U.S. response. A little bit of a think piece, but we think this is the roadmap going forward for the U.S. now, in combination with all the other things we're doing. Basically, this is the U.S. answer to things like Enbridge. Enbridge says commodity settlement. U.S. says, okay, commodity settlement, but use dollar rails. China says, buy our goods. U.S. says, okay, buy their goods, but use dollar payment rails. It's all about being the global reserve currency now and the substantial, unobvious power that it brings with it. So we have to offer upside because they don't trust us anymore. That's how I look at it. Moving on. PPI is this week. Today is Case-Shiller Home Price Index. Please support independent media. Buy a hat, mug, or hoodie today, or buy a coffee for the Gold Fix interns. We appreciate that. Let's move to yesterday's action, and today's for that matter. Let's start with silver. Again, I pointed out that this is not a measured move, but it has similarities to it. And essentially, I think I said on Twitter last night before I went to bed, or on X, I should say, that you either sell it here or you sell it at 110. So I think the selling's going to come in here. Notice that when China came back online, the market opened weaker. Gold was strong, silver was weak, and silver was strong. There's a lot of chaos over there as they square their books up. And remember, they do have a big short player out there beyond Jiming from Zhangkai. So who cares who's short, whether it's them or us, whether it's JP Morgan or everyone's short. Everyone is short silver. Nobody has enough silver. So whether we are less short than they are, doesn't matter. This is why the market is driving the way it is. Notice that silver is completely decoupling from gold, at least last night during Shanghai hours. But that's where the action is. Now in the US, I would say to you, if you're looking for the US to buy the open, don't. Look for the US to buy the open if the dollar is weaker. If the dollar weakens, then the retail will come in. If not, if the dollar doesn't weaken, then look for this market to be under pressure today. But, that silver candle is, the day is young, but that silver candle looks really good. So let's see what happens. Sometimes you just got to watch. Gold, yeah. So here you have red and green, red and green, red and green, red and green. Now you got green and red, right? Up, green and red. This is the first pushback we've had on gold since, I would say, since here. I don't call that a pushback, but this is a pushback. I would say if you're going to trade the day, you want to be bearish biased unless we get above 522 and 52.22. And I don't think we're going to get above 52.22. And I hope I'm wrong on that one. But I am long silver. As I said, I have a butterfly position on or a condor type position on. That's bullish bias, but I'm collecting some premium. So we'll see what happens. I'm Vince. Have a great day, everyone.